Good afternoon, everybody. My name is Francisco Luis, and I'm a tax partner at Kevane Thornton. First of all, thanks for joining us today to participate in our webcast on Puerto Rico's Acts 20 and 22. We have a great number of participants, so we thank you for joining us. Our main plan today is to discuss and present over the next 50 to 60 minutes the recent developments that we have had with these incentives in Puerto Rico. Before going deep into the technical aspects of our discussion, we first want to discuss some housekeeping information with you. The current slide shows the dial numbers and access codes to listen to the webcast. You have that information here. Please be all informed that by default, everyone on the line is muted. There is also a chat window where the participant can make questions or comments. Please state your name and email address. Most probably, we won't have time today to answer all of questions, but shortly after the webcast, you will be contacted by personnel from Kevane Thornton to address your questions, comments, or concerns. In addition, this webcast is being recorded. This is the specific agenda that we have for today. First, we're going to have some introductions and contact information in case you need to contact us in the future. We're going to bring you, in a nutshell, the summary of Act 20 and Act 22, and then we'll go more deep into each of the acts to go over the benefits and the requirements. There has been some new changes to the law that have brought some additional requirements. We're going to discuss the interplay with the U.S. federal tax implications, and also we're going to address all issues that we need to address at the beginning of the planning and work out the strategy to have a successful planning in the future. In addition to that, we're going to discuss some additional federal tax issues that we have to keep under the radar, keep in mind, and we're going to show you a case study illustration with and without the benefits of Act 20. In addition to that, after 4 years, we're going to present you what has been the results of Act 20 and Act 22 in Puerto Rico, and what is the forecast of what's being projected for over the next 10 years. There are also other tax considerations that you need to be aware of major things that are happening in Puerto Rico, which we are going to present you. And after that, we'll also present you our firm, some key facts, and how we can assist you with these opportunities. This is our contact information in case you need to contact us. This is our main line of the telephone number of the office and my extension 208. My name again is Francisco Luis, and this is my mobile number. And here you have also my email address. Please take a moment to write down any information you need from this. In case that you want a copy of this presentation, please do not hesitate to contact us after the webcast. We'll gladly share this with you in the future. So let's go to the discussion. As you know, Act 20 and Act 22 were approved in the year 2012. Specifically, Act 22 promotes incentives for individuals who relocate to Puerto Rico, and by providing 100% exemption on interest, dividends, and certain capital gains. Now, keep in mind that these exemptions are for Puerto Rico tax purposes, so we have to monitor and consider the federal tax aspects of this type of income. Act 20, on the other hand, provides a low maximum tax rate, a flat tax rate of 4% for new export service businesses that are established here in Puerto Rico. In essence, the cornerstone of this benefit is the related interplay that they have with the federal tax rules, having two elements as key in the planning: the source of income and the residence of the taxpayer. In regards to Act 22, the exemptions that are provided for the dividends, interest, and capital gains are granted in a tax exemption grant. This decree will last until year 2035. One of the main benefits of having this plasmated in a grant, in a decree, is that this is like a contract, and it will prevent any future amendments of the law. Basically, the tax exemption decree will grandfather those. For example, one of the new requirements that we have had here in Puerto Rico that were approved at the end of 2015 for those applicants that filed prior to that to those amendments, they are grandfathered and they don't have to comply with the new requirements. We're going to discuss those new requirements shortly. There's a main requirement, and is that the bona fide resident must not have been a resident of Puerto Rico at any time during the 6-year period preceding the effective date of the approval of the Act 22. That date is January 17, 2012. You should not have been a resident of Puerto Rico 6 years prior to that date. The element and the interaction with the U.S. tax law is that although U.S. citizens remain subject to full federal income tax regardless of their domicile, the U.S. Internal Revenue Code provides special rules for an individual who is a bona fide resident of Puerto Rico. And in essence, that individual is able to exclude from federal taxation the gross income that is determined to be from sources within Puerto Rico. Last year, Act 187, approved in November 2015, brought some new requirements. Now, new applicants that filed their application after November 30, 2015, are required to acquire a residential property in Puerto Rico, and this is a condition to granting the exemption tax decree. Subsequent to that law, the Puerto Rico Department of Economic Development and Commerce issued Circular Letter 1503 to expand upon this matter by stating that this new requirement must be met within 2 years from the date of notification of the Puerto Rico residency through evidence of execution of a deed of purchase. Now, there's no requirement that the individual has to live in this personal property, in this residential property. For example, the new applicant may lease its personal property, but should acquire another residential property that it can lease to a third party. There's another new requirement in this law, and is that all applicants are required to provide evidence of a personal or commercial bank account in a financial institution or credit union with presence in Puerto Rico. As we will discuss shortly, this is also a requirement that you have to meet for federal tax purposes. Now, we have discussed and we have mentioned the phrase Puerto Rico bona fide resident. And this is a key element for this planning, because according to Section 933 of the U.S. Code, the following should not be included in gross income and should be exempt from federal taxation. And this is that in the case of an individual who is a bona fide resident of Puerto Rico during the entire taxable year, the income derived from sources within Puerto Rico is excluded. So that's why if you are a bona fide resident of Puerto Rico, you are not required to file a U.S. tax return if all of your income is from sources within Puerto Rico. But in order to be considered a Puerto Rico bona fide resident, you have to meet the following 3 tests, and you have to meet the 3 of them. First, the present test. Second, the tax home test. And third, the closer connection test. The present test probably is the one that you have heard more outside. And this is, you have 5 alternatives to meet this test. If you meet any of the 5 alternatives, you meet the test. The first alternative is that you have to be present in Puerto Rico for at least 183 days during the taxable year. Another alternative to meet this test is that you have to be present in Puerto Rico for at least 549 days during the 3-year period that includes the current taxable year and the 2 preceding tax years, as long as the individual has also been present in Puerto Rico for at least 60 days during each year. So if you are going to rely on this alternative, you're going to be able to rely on it after you have been in Puerto Rico for 3 years. Another alternative to meet the present test is that you cannot be in the U.S. for more than 90 days. The 4th alternative is that you did not have more than $3,000 of earned income, and when you count your days in Puerto Rico and your days in the U.S., you should have been more. You should have had more days in Puerto Rico than in the U.S. If you cannot meet any of the four alternatives that I just mentioned, you have the fifth alternative, and this is that you cannot have a significant connection to the U.S. And this means you cannot have a permanent home in the U.S., and this has a very broad interpretation because, for example, if you have a room in a family member house in the U.S., that's considered to have a permanent home. So you cannot have any property or any place to stay in the U.S. The second implication of the significant connection to the U.S. is that you cannot be registered to vote in the U.S. So if you move to Puerto Rico, you will not vote for the president. The third alternative, or the third implication of having a significant connection to the U.S. is that your spouse or your child should not have a home or a place of abode in the U.S. So actually they have to move here to Puerto Rico with you. So, but keep in mind that if you meet any of the previous four alternatives of the present test, there's no issue with having a property in the U.S. It's just that you cannot have this property in the U.S. if you are not able to meet any of the first four alternatives to meet the present test. Let's go to the tax home test. The tax home test, in essence, you should not have a tax home outside of Puerto Rico, and this is generally satisfied if the taxpayer's regular or principal place of business is in Puerto Rico. But what happens when you cannot determine where is your principal place of business? Well, the tax home test will be satisfied if Puerto Rico is your regular place of abode in a real and substantial sense, subject to a subjective analysis of facts and circumstances. So you have to actually demonstrate that you have your home here in Puerto Rico. The third test that you have to meet in order to be considered a bona fide resident of Puerto Rico, and this is for federal tax purposes, is the closer connection test. You must have a closer connection with Puerto Rico than with the U.S. And the regulations provide several factors in order to meet this test. For example, where is the location of your personal home? Where is your family? Where are your personal belongings? Where do you conduct your social, political, cultural, and religious activities? Where do you have your routine banking activities? And remember that this is now also a requirement for Puerto Rico tax purposes under Act 22, with the amendment that we just discussed of Act 187. Your business activities have to be here in Puerto Rico, and Puerto Rico has to be the jurisdiction where you hold a driver's license and where you are registered to vote. So you will not vote for the president, but you will vote for the governor of Puerto Rico. The residence of Puerto Rico has to be designated on all governmental forms and any official documents that you have. Now, after the discussion of the bona fide resident, we also have to address the sourcing income. What are the source of the rules for determining the income sourcing rules? In essence, the interest and dividends, the sourcing of the interest and dividends are determined based on the payer. So whoever is paying interest or dividends determines the sourcing of that income. So interest and dividends that you receive from Puerto Rico residents or Puerto Rico corporations organized under the laws of Puerto Rico constitute Puerto Rico source income. However, if the taxpayer owns at least 10% of a Puerto Rico corporation, the dividends are treated as Puerto Rico source only with respect to the following formula. And basically is that entity, the income that you earn, the income that the entity earns in Puerto Rico vis-a-vis the income that generates worldwide, that ratio is the one that you're going to apply to the dividend to determine the Puerto Rico source. The other implication is that if 80% or more of the gross income of the entity is from Puerto Rico sources, and 50% or more is from an active trade or business, so it cannot be passive, within Puerto Rico, all the income is considered to be from Puerto Rico sources. In the case of capital gains, the general rule is that capital gains from the sale, exchange, or other disposition of personal property is sourced according to the resident of the taxpayer. But there is an important exception that we have to discuss, and it is that for U.S. tax purposes, in the case of property other than marketable securities owned prior to becoming a Puerto Rico bona fide resident, the U.S. source portion of the gain is attributable to the U.S. holding period and is determined by the following formula. Basically, you're going to calculate what's the total gain of the disposition of the property. This is here. And you're going to multiply that by the following formula, which is that the number of days that you held that property in the U.S. as a U.S. resident against the total number of the holding period that you have held the property. And when you multiply that for the total gain, you're going to have the U.S. portion of the gain that is going to be subject to U.S. taxation even though you have moved to Puerto Rico. So if you have property that is not a marketable security and you dispose that after you move to Puerto Rico, there's always going to be a U.S. taxation on that attributable to the holding period that you held that property as a U.S. resident. And there's another consequence for Puerto Rico tax purposes, and it's that the entire long-term capital gain related to any appreciation that you have on personal property acquired prior to becoming a resident of Puerto Rico, the following applies. For Puerto Rico tax purposes, there will be a 15% tax on capital gain realized within the first 10 years of becoming a Puerto Rico resident. If you sell the property after that, the tax rate in Puerto Rico will be a 5%. But obviously before January 1st, 2036, which is when the benefits of Act 22 elapse. So in this case, you are probably going to have a double taxation because if you acquire property that you're going to sell after you move to Puerto Rico, but you acquired that property prior to moving to Puerto Rico, there's going to be a U.S. portion of that is going to be taxed in the U.S., and Puerto Rico will always pay a tax on that, 15% if you sell that property prior to 10 years, 5% if you sell that property after that. Now let's go to Act 20. Act 20 provides for a 4% maximum tax rate for the net income earned in certain eligible services that are performed here in Puerto Rico to markets outside of Puerto Rico. These benefits are secured in a tax extension decree for a period of 20 years, with the option to extend them for an additional 10 years. So you may enjoy these benefits for 30 years, to a maximum of 30 years. Now, the eligible services must be rendered in connection to an activity that has no nexus in Puerto Rico, and the services, as I mentioned before, have to be provided here in Puerto Rico, and the recipient of the service must be an outside market of Puerto Rico. So the functions that are being billed to the outside market have to be provided here in Puerto Rico. The current requirements, and this includes the new amendments of that Act 187 brought last year, and is that there's the current requirement for employment is that you have to employ at least 5 employees here in Puerto Rico, and they have to be Puerto Rico residents. The circular letter that the Department of Economic Development issued last year clarified that you have 6 months to employ the first 3 employees, and you have a period of 2 years to reach to the 5 employees that you are required to employ as a minimum. Prior to the Act 187, there were no express employment requirements in Act 20. The public policy back then was that the agency that handles this was requiring at least 3 employees. These are the eligible service, the eligible activities that you can perform under Act 20. Later in the presentation, we are going to show you what has been the experience and what are the activities that are more being used under Act 20. But you have all of these activities. There's also the discretion and the authority to the Secretary of the Economic Development and Commerce Department to grant any other activity that is determined to be for the best interest of Puerto Rico. So you have discretions also to include additional activities through the negotiation with the agency. What is the typical structure that we see, that we have seen in the past years? Generally, the new Puerto Rico resident will create a Puerto Rico LLC, a NUCO, and to provide services under Act 20 to another entity, probably controlled by him as well in the U.S. And the new resident will also become an employee of the NUCO, and that will also help to meet the requirement of the employees because the owner can be one of the 5 employees that are required. Thus, the service fee income will be deducted in the U.S., and in Puerto Rico, that income will only be subject to a 4% tax. Since the services will be performed in Puerto Rico, they are Puerto Rico source income. So, what are the issues that we have to monitor with this? First of all, transfer pricing considerations. If the services are provided to a related entity in the U.S., that fee must be an arm's length fee, and that should meet the requirement of the U.S. Code, Section 482, because there are sections in the U.S. Code that assess transfer pricing penalties, but those penalties will not be imposed if the taxpayer satisfies the certain methods and documentation requirements that are provided in the regulations. The taxpayer, to meet this, must prepare a transfer pricing study in order to comply with the requirements of Section 482 for the U.S. tax purposes. We typically hear a lot about the alternative of, instead of a transfer pricing, having a benchmarking analysis, and this will not work. What we have seen in regards to the benchmarking is that this may serve as a preliminary tool to determine the charges among related parties, but this will not avoid the penalties and sustain the challenges from the IRS. However, the work that is done for the benchmarking analysis in the initial phases of the structuring and the planning stage helps facilitate the work that is going to be needed for the transfer pricing if the taxpayer decides to go ahead with the structure. Now, if you have operations in the U.S. and you want to transfer those to Puerto Rico to continue your business, you have to consider that for U.S. tax purposes, that's going to be considered an outbound transfer, and you have to monitor the earnings and profits that that entity has because it's going to be subject to tax, in addition to other tax considerations, like, for example, any intangibles that the entity has in the U.S. Another issue that we need to monitor is the place where the services are being performed, because this determines the sourcing of the income for such services. So if NUCO or the taxpayer renders services in the U.S., this will generate U.S. source income subject to U.S. federal tax. So you may have the entity being taxed in the U.S. or the individual as an employee of the entity. In addition, any income that is not performed here in Puerto Rico, even though it's an eligible activity, will fall out of the scope of the benefits of the Act 20. Furthermore, if the taxpayer is an employee of NUCO, adequate compensation under an arm's length standard must be structured to avoid challenges from the Puerto Rico Treasury Department. And on this regard, last year, the Treasury Department issued Administrative Determination 1522 to provide guidance on the imputation of wages to stockholders or partners that are or also employees of an entity that holds an exemption grant under Act 20, Act 273, and Act 399. Given the problematic of to properly determine the reasonable amount of taxable compensation vis-a-vis the amounts to be received as tax-free dividends, it states that an officer owner should receive an annual reasonable amount compensation of up to $350,000. In that administrative determination letter, an officer and owner is defined as an individual that is a Puerto Rico resident and devotes no less than 80% of his time to the eligible activity under Act 20. So if you want to be excluded from the definition of an officer owner and you want to devote less than 80%, keep in mind that then you will not be a full-time equivalent and you will not be counting for the 5 employees that you have to meet for Act 20. Prior to this administrative determination letter, Treasury also issued another administrative determination in year 2010, which established the rules for the imputation of wages to officer owner that was based on prior incentives acts prior to Act 20. And in that time, the guidance was that an officer owner should receive as taxable compensation the lesser of 30% of the net income of the entity before the owner's compensation, or $250,000. Interestingly enough, the new administrative determination letter issued in 2015 makes no reference to this prior letter, nor makes reference to a ratio of the owner's compensation to the entity's net income. Not only that, we have in Puerto Rico a Puerto Rico Supreme Court case, which is Kruger versus Secretario de Hacienda, and neither the Administrative Determination 1522 nor the one issued in 2010 makes reference to this right-on-point case that was settled. The facts of the case were as follows. There was a manager in a U.S. company that was offered to move to a manufacturing plant here in Puerto Rico. That manufacturing plant had an exemption decree that granted, among others, free taxation on dividend distributions. As part of the negotiation for the transfer, the manager acquired a minority interest in the exempt business in Puerto Rico, and he paid for those stocks. The manager was offered a taxable compensation package that was similar to the one that he had in the U.S. Actually, in the first year, it was also increased. So in years from 1952 to 1957, the manager received taxable wages and also exempt dividends, which Treasury challenged that the treatment of the dividends based on the grounds that they were not in proportion to his investments because were significant and were in fact additional compensation. The court in that case ruled in favor of the taxpayer and established two main holdings. First, as a general rule, the amounts of dividends to be paid and if they should be issued or not is a matter that relies primarily on the corporation's board of directors. The second main holding is that in regards to the determination for tax purposes, if a payment is considered or not a dividend or additional compensation, the intentions of the parties is a determinant factor. So we are faced with a clash of determination. We have on one hand a 50-plus year decision from the Puerto Rico Supreme Court, and now we have two recent determinations, guidance from the Secretary of Treasury without any reference to the court decision. However, we cannot forget that there's a section in the Puerto Rico Internal Revenue Code, section 104009, that provides authority to the Secretary of Treasury to apportion taxable income where, at his discretion, there is manipulation of transactions among related entities. So that's a nutshell of Act 20 and Act 22. We also want to present you some general concepts or issues from the federal tax perspective that we need to keep in mind. This is a very complex area, and we're just going to highlight some concepts just to keep them under the radar. What is a control for a corporation? And you probably have heard about the CFCs. And this is when more than 50% of the foreign corporation, both in power or value, is owned by a U.S. shareholder on any day during the foreign corporation's taxable year. So if in any day a U.S. shareholder holds more than 50% of the voting power of or the value of a foreign corporation, that's a CFC. And entities created in Puerto Rico, even though Puerto Rico is a U.S. territory, a U.S. possession, they are considered foreign entities for U.S. tax purposes. So what is a U.S. shareholder? A U.S. shareholder is a U.S. person who owns directly or indirectly or constructively, and there are some technical attribution rules that we have to consider, 10% or more of the total combined voting power of all classes of shares in the corporation. So we have to go and see what's a U.S. person. And interestingly enough, it includes the U.S. citizens, the individuals, and several entities, but it excludes from that definition the bona fide residents of U.S. possessions. So if you have a bona fide resident of Puerto Rico, for these purposes, is not considered a U.S. person, so it's not considered a U.S. shareholder, and it's not considered to have an ownership in a CFC. So in addition to the definition of the CFC, we have to consider also what's the definition and the implications of the subpart F income. And we're going to bridge these two concepts together in just a few moments. In essence, a super F income, we have these 5 alternatives of type of super F income. The fourth alternative, which is the one that we have here, is the one that concerns us here at this moment because of the type of activities that will be performed on the Act 20. And how is the super F income treated? Well, is basically the income of the CSC is considered to be includable for the U.S. shareholder, similar as if this would have been a dividend distribution. So basically, it acts like a pass-through for U.S. tax purposes. And what is foreign-based company service income, which is what will make to have the super F income? And this is the income derived from performance of specified services for or on behalf, and we underline this because this is very important, a related person outside the country where the CFC is organized. And this is the type of service income that are considered for these purposes: technical, managerial, engineering, architectural, scientific, industrial, commercial, and services like this. So if the CFC receives assistance, substantial assistance from a related party outside of Puerto Rico, we will have super F income. And the regulations help us to determine whether or not that entity is considered to be receiving substantial assistance. So and why is this important? This is important in cases where we have a combination of shareholders where some of them are Puerto Rico residents and some of them are U.S. residents. We want to make the planning for those U.S. residents to work as well. So we have to monitor the CFC issues and the super F income. Now we're going to show you a case study illustration in order to quantify and to see the Act 20 in place. These are the assumptions for our case study. Let's first of all, the CFC implications and any transfer pricing studies requirements, among other important considerations, are properly planned and addressed. And we create a service entity in Puerto Rico with U.S. citizens as shareholders. Then the second assumption is that 75% of those shareholders relocate to Puerto Rico and 25% of the shareholders remain as U.S. residents. Now that entity is going to charge $1 million of service fee from services provided in Puerto Rico to the U.S. And let's assume for these purposes that the combined U.S. and state corporate tax rate is 40% and that the dividends are taxed in the U.S. at the rate of 23.8%. So without the Act 20, basically the $1 million will be taxed at the combined tax rate of 40%. So this will represent a tax of $400,000. So $600,000 will remain as earnings and profits, which are going to be distributed to the shareholders in the U.S. The shareholders are going to tax those dividends at the rate of 23.8%. So you have an additional tax of $142,000. So the total tax paid by the corporation and then by the individuals, by the U.S. By the shareholders, is $542,000 for an effective tax rate of 54%. Now, if we will have structured this under Act 20, the $1 million of service fee will have been taxed at the rate of 4%, resulting in a tax of $40,000. Thus, $960,000 will remain as earnings and profits. 75% of that will be distributed to the Puerto Rico shareholders, and there will be no tax on that portion of the dividends. The 25% of the remaining earnings and profits are then going to be tax distributed to the U.S. residents at the rate of 23.8% tax. So the tax for them is going to be $57,000. So we will have a combined tax rate of $97. This is a 9.71% effective tax rate. Obviously, if all of the shareholders will have relocated to Puerto Rico, the only tax will have been the 4% tax, the $40,000. so for an effective tax rate of 4%. So what have been the results of Act 20 and Act 22 after 4 years? On December 18, 2015, the Department of Economic Development and Commerce published an impact study on the results of Act 20 and Act 22. This was commissioned to an independent economic consulting firm. So as of November 2nd, 2015, there were 360 tax exemption decrees approved under Act 20. And you can see the trend here that has been increasing since the beginning of Act 20, year 2012. These are the main eligible activities that these entities are performing, having consulting services as the main activity. Take a moment if you want to take any notes here. Basically, almost all of the eligible activities has been used. And what are the markets that are being used as to export these services? USA is the dominant market, but we have a lot of other countries that has been used to export services from Puerto Rico. And when we are looking at other countries other than the U.S., we have to consider some international tax issues because most of these countries impose withholdings, even though the services are provided here in Puerto Rico. And we have the particular situation with Puerto Rico that we don't have any tax treaty with any country. And we cannot use the tax treaties that the U.S. have. So as part of the planning, we have to consider these issues and see alternatives, like, for example, use bridge countries in the middle of the structuring, like, for example, Spain or the Netherlands, that has a lot of tax treaty with most Latin American countries. In regards to the employment statistics of the Act 20 companies in the first 4 years, almost $140 million has been paid in salaries, with an average salary per person of $42,000. And this is very interesting because when we compare this $42,000 per employee in the Act 20 entities, vis-a-vis with the private and public sector in Puerto Rico that has an average of $27,000, the Act 20 company has resulted to be a higher payer employer. The direct, indirect, and induced employment generated by Act 20 companies have accounted for a total of 7,000 jobs here in Puerto Rico. And the average number of jobs per tax exemption decree is close to 9.3 jobs. So it's actually exceeding the minimum of 5 employees. In regards to the economic statistics of Act 20, they have reported a total of $1.2 billion of service fee performed here in Puerto Rico. The total investment, even though this is not an actual requirement under Act 20, has been close to $143 million, having real estate composed $31 million, machinery and equipment $35 million, and other assets $77 million. Act 20 alone has generated more than $60 million in tax revenues. The 4% has represented in corporate income tax $34 million. The individuals working at the Act 20 company has paid $17 million in taxes. There also has been sales taxes, $3.5 million, and municipal taxes, which is like a grocery receipts tax here in Puerto Rico, that has paid approximately $2 million. And with respect to this municipal tax, just to keep in mind, this is a tax on volume of business generated here in Puerto Rico, and the tax rate is 0.5%. But Act 20 grants 60% exemption over that tax. So these $2 million is net of that exemption. With respect to Act 22, as of November 2nd, 2015, there were 574 exemption decrees approved under Act 22. And even though you may see here in the graphic that, for example, there was a trend that it was increasing, and in 2015 you may believe that it has decreased. Well, there are approximately 180 exemption decrees that are still in process. So basically, when they are approved, we're going to reach probably to the 750 tax exemption decrease as of 2015. What's the main occupation of the Act 22 individuals that have moved to Puerto Rico? Most of them are consultants, traders within the financial industry, entrepreneurs, and investors. And 89% of them have come from the U.S. But we have had places like Venezuela, United Kingdom, and Spain with a lot of cases. And we have had people from more than 50 other countries that have moved to Puerto Rico under Act 22. Where do they come from the U.S.? The main place has been Florida, followed by Texas, California, and New York. But basically, participants have come from all other states except for Delaware, Hawaii, Maine, Mississippi, and New Mexico. The investment they have made in real estate, and this is prior to Act 187, which now has this as a requirement, has been $266 million in real estate acquisitions. What the impact study forecast for the next 10 years? From 2015 to 2022, a total of 2,351 additional Act 20 decrees are expected. Those new exemption decrees should create a total of approximately 45,000 new employees here in Puerto Rico. The gross revenues that is anticipated from these new decrees is $38,000 million over the next 10 years. And the corporate tax of 4% flat tax rate that this will represent is approximately $809 million for Puerto Rico. And this is very interesting because the value of real estate purchase that will be purchased by the Act 22 decree holders could be up to $1.7 billion. And this will depend on the available inventory. And right now, as of 2016, we have an excess inventory here in Puerto Rico. So the market is fertile. There are also other considerations that you need to be aware and that will be happening shortly here in Puerto Rico, and it's with respect to the indirect taxes. As you probably have heard, the current sales and use tax will be replaced effective April the 1st, 2016 by a new value-added tax, and this is not an April Fool's joke. This is happening now. The export sales will be, under that new law, will be taxed at the 0% tax rate, so the merchant will be able to credit the VAT on all of its inputs as long as there are no exempt sales. Once certain requirements are met, that excess VAT may be refunded. And there are also other indirect taxes that you need to consider, which includes property taxes, both real and personal, municipal taxes, which we just briefly discussed, and other excise taxes, among others. And this is our firm, Kevane Grant Thornton. We were founded by Donald Kevane in 1975, so we have over 40 years of experience. We have been a member of Grant Thornton since 1984, and we also have an international business center that provides a gateway to the resources of Grant Thornton globally. IBCs are led by a member firm partner around the world with a wealth of experience in international business. So these IBC positions help us when we are structuring with the international issues. Our firm has 10 partners, and we have approximately 125 employees. How we can assist you with this process? Well, we typically has assisted in the design implementation of the structure, considering all relevant Puerto Rico, U.S., and international implications. As part of this phase, we do feasibility analysis, forecast evaluation of the tax benefits, and we assist with the strategy to achieve the requirements. We also assist in the creation and choice of entity, in the assistance and the representation in order to obtain the tax exemption decrease, and this is something that most accounting firms do not perform, but we are doing this. We assist with the transfer pricing studies that you need, not only for U.S. tax purposes, but if you need them for Latin America as well. And we also assist in the compensation and tax planning. We discuss the situation that we have with the clash of determinations from the courts and the guidance provided by the Secretary of Treasury. And after that, we also assist with the preparation of tax returns, the audit of financial statements that you will need here in Puerto Rico, and any outsourcing needs that you may have in the future for accounting and payroll tax matters. What can you expect from us? A greater partner attention for clients. We have the highest ratio of partner to professional staff in the industry, and we have, in essence, a team dedicated to your business. You will receive high value for your fees, and we certainly have the sector expertise. And this is Grant Thornton International. We have a member firm in over 130 countries. We have approximately 40,000 employees around the world. So everything that you see in this map that is purple, we have a presence there. And lastly, we want to mention that before March 15, we will be launching our 2 firm publications, Doing Business Guide in Puerto Rico and the Puerto Rico Tax Incentives Guide. In regards to the doing business, you may use this publication as a general reference of the investment environment and any information of legal, accounting, and taxation framework that is essential to keep you on the right track here in Puerto Rico. And there are several other incentives guides in addition to Act 20 and Act 22. In this investment guide that we're going to publish, we're going to summarize them for you. So if you have any questions or comments, please use our contact information that we provided at the beginning of the presentation to contact us. It will be certainly a privilege to help us. So we thank you for your time. We are almost 50 minutes after we commence, so